Attendees are in listen-only mode.
Welcome everybody, and welcome to some new faces to this webinar series. And over the last few sessions I've outlined the purpose and the scope of what we're doing with these webinars. I'm going to revisit that periodically, but if you're new to the webinar series, please feel free to ask any questions at all. There's a few areas that I can't go because of licensing laws, and that's I can't give specific stock recommendations in this forum. Can obviously do that to people who are members of Specialist Share Education, but not in this forum. And also, of course, in all fairness to our members who are paying for this information and high-level support. But look, certainly I can go in many places, so please feel free to ask questions. Now, just need to, well, we always start with a little bit of humour. I try and do that, put a little bit of a smile on your face, and obviously with the Queensland elections over the weekend, there was plenty of material around, and I found these couple of cartoons today which I thought were pretty priceless, really. This first one here, obviously Anna Bligh wearing a Captain Bligh hat, throwing her resignation in the dirt and saying my work here is done after she's wrecked the ALP. Thought that was pretty clever. And here's another one that really amused me. Julia with a sword in her back from I guess any one of several people, saying, "Anna, I told you to be more upfront before the last election," as she kicks her off the plank. So yeah, a little bit of humour out of the Queensland election. I don't think the Labor Party's seeing the funny side of it at the moment. Anyway, let's move on. I'm operating under the Licence of Financial Services of Australia, and this is general advice only, prepared for the public. So, quick global recap. The S&P still pointing higher, and I think we're in for a pretty reasonable period for at least the next 6 to 8 weeks. There are things in Europe that could disrupt that, but I think largely the fear of a systemic collapse in Europe has passed now, and so people are taking a much more positive and risk-on kind of attitude at the moment. Now, we had a recent pullback, and we'll have a look at the chart in just a minute, but it was a recent fairly small pullback. Just got rid of a little bit of the excess, pulled back to the mean moving averages, and look, that might be all that's needed just to kind of clear the way for the next advance. And I've had 1440 as a nominal target for quite some time once we broke above 1375, 1380. But look, that's just a structure. It's not a prediction. I'm not in the business of making predictions, because I think that's really fraught with danger. All I do is I develop structures that have a certain higher probability associated with them, and then I use that structure just to watch the market around those kind of key levels. So please don't take that as a prediction. It's just a working structure that helps me focus my attention on what the market might be doing at those various levels. Now, don't be surprised if we see some consolidation near term, because we've really had a huge run since November in the S&P, and we've really only had 2 tiny little pullbacks that lasted a few days. So I wouldn't be at all surprised to see at least some consolidation in this area here. In other words, by consolidation I mean just a period where the market's going to go up and down for a week or two and essentially not make any net progress. But overall, with the US market, I'm really expecting 2012 to be a pretty solid year. Typically, from a seasonality point of view, we see markets run reasonably well into May. We can then often see a bit of sideways to down through June, July, August, and then we get some more positive trading conditions. It's an election year in the States, so that seasonality would play out pretty well, and with the real fear over Europe off the table now, and manufacturing making a comeback in the US, and corporate America in pretty good shape, it's really hard to see anything terribly nasty happening this year. Now, the ASX still lagging significantly, but consumer confidence just taken a little bit of a turn for the better, so it'll be very instructive to see if that is sustained. As far as this week goes, there's not a lot of news due out of any real significance either in the States or here, so I'm expecting that we may just see certainly at the index level, the market just kind of meander sideways a bit. Obviously the high Aussie dollar is an issue for large cap stocks, and that's why I don't have any expectations of a consistent trend in large cap stocks. I'm really looking just to play the ranges in the large caps. And it's small caps where all the action is, but very much a stock picker's market. This is not a market that is lifting all small caps. It is very, very specific, and as there's a bit of frothiness in some parts of the small cap sector, you do need to be quite careful with entries and exits. Okay, quickly looking at gold. We'll look at all these charts in just a minute. The second leg correction looks to be complete to me. I certainly think that's where the odds are. And last session I wrote that the bottom may be close, because I was certainly seeing a lot of evidence that traders were giving up on gold. I was getting a lot of questions about gold stocks and why they were falling. We saw some wonderful gold stock businesses being sold off to what I think is unreasonable levels, and they're all signs that we're close to a bottom. Now, gold stocks have rebounded a little bit today from, in some cases, stupidly oversold levels. When you see quality gold producers with no debt, lots of cash in the bank, trading at price earnings multiples of 3 and 4, then you know that's pretty dumb and it's not sustainable. Silver is obviously tracing out a similar kind of pattern to gold, and it's just going to follow along. And oil remains in a pretty strong trend, and as per last week, gas stocks are all the rage. And are they getting a bit frothy? Well, you'd have to think so, the way that some of these stocks that really are just in the middle of drilling programs, they haven't really delineated anything substantial in some cases. I think it's getting a bit frothy, but anyway, we'll see. Now, let's just have a look at a few charts. And the main purpose of this session is to answer your questions, so I'll keep this fairly short. So if you haven't looked at a chart of this recently, and I covered this in the weekend market update videos, which are available in public forum on YouTube. But this is how I see the S&P. We had a leg up which started on the 28th of November. That was the first leg up. We got a correction of that leg, which is perfectly normal crowd behaviour, the disbelievers doing a bit of selling. We then get the main part of the run, which really ran from around 20th of December to the end of November. We then got a short pullback, which involved one sharp day down, which was the 6th of March. And we are now into the fifth leg of this part of the advance, and that'll probably go up in a series of steps and stairs. And if I'm somewhere near the mark, then it may terminate somewhere around about the 1440 mark, but that's only an approximate target at this stage. Now with gold, we've had the first leg up in this new move is started on the 29th of December and ran up to a high at the end of February, so pretty much consistent with stocks. This is now our second wave pullback down. I had a target level of 1627, and it reached a low of 1628 last Thursday night. Bounced from there and has gone on with it today. Gold and silver trading a little bit higher. So technically and from a sentiment perspective, I think that does stack the odds a bit in the favour of the fact that gold has possibly now bottomed and may head higher. But I wouldn't necessarily bet your house on that. Silver's showing a fairly similar pattern, so I won't cover off on silver. But one chart that you really should keep an eye on is if you can get your hands on this chart, is the 30-year US Treasury bond yield. And you can see here that we had a spike up, basically obviously 30-year Treasury bonds, which really determine mortgage rates in America, and the Fed's been trying everything they possibly can to squash those yields down as low as possible. They managed to get them down under 3%, which is pretty much historic lows. We got a little breakout blip in October, and then it settled back down again. We've now had another breakout blip in the last week or two, and we don't have enough information yet to know whether this is the start of a new trend. If it is, that's telling us very clearly that the market is expecting a breakout in inflation. That will be good for gold. That will be exceedingly good for gold. It won't be so good for the American mortgage market, but it certainly will be very, very good for gold. Let's just have a quick look at oil, and I'll just look at the NYMEX sweet crude, and you can see we had a spike here up to nearly $1.14 in April of last year. This is a weekly chart, and we've been back almost to that level again in recent weeks, and it's really just consolidating over the last month or so. So there's some of the key charts. Just looking at the opportunities, to my mind, there's no question the oil and gas sector is the strongest. There are numerous breakouts, but just be careful with them. Certainly care needed on the entries. Gold producers, the overwhelming odds favour a surge in the coming months. They are so oversold and so lagging behind the gold price, it's ridiculous. That doesn't guarantee that they will go up, but I can tell you there's an incredibly high probability that they will go up at some stage, and I believe that that may not be too far away, just looking at all of the indicators and signals that I look at. Resource service companies are also another great area to play in. There's still a few good ones that haven't moved as yet, and that's probably, as we saw in the gold rush of the 1980s, the 1880s, the people that really made the money were the guys that sold the picks and the shovels, and I think playing the resource service companies is a safer and more stable way. It's less spectacular, but it's certainly a more stable way to play the resources boom over the next decade. And there's going to be plenty of strong opportunities on pullbacks, but we may not see significant pullbacks perhaps until we get into the middle of the year if the US market does weaken off a little bit. Now, just a couple of thoughts in general, and I know that certainly some of the people that are joining us for the first time are relatively new traders. So just some thoughts on what traders really need in terms of the basic fundamentals. So if you've got less than 10 years active experience in the market, then you probably need the following. And I know it's tempting when you've got you've been in the market for 6 months or so and you've had a few wins to think that you know it all. But I can assure you, you actually have to go through many, many market cycles. You have to get beaten up quite a few times. I started trading in 1987, so I know what getting beaten up is all about because I started before the crash. So you've got to go through those market cycles to really be able to have unemotional, disciplined reactions to the market when it does all sorts of weird and wonderful things. So to me, unless you've got a lot of experience in the market, you do need some assistance with entry and exit techniques and risk management. And the sort of things that work really well don't come naturally to almost anybody. They can be learnt, but they don't come naturally. You need education on the practices that really do make the difference. In other words, learning some of the shortcuts. There's an absolute mountain of information out there, and you can spend a lot of time reading a lot of things, but the issue is what parts of it are really the important parts you should focus on. Thirdly, you need support and guidance for when the market is not kind, and at the moment the market is a pretty kind place, but there'll be many times when it's not, so that you you can exercise a degree of consistent unemotional behaviour. And I can tell you from reading some things of late, there's an expectation out there that you can get this stuff from books and doing some courses. You cannot. There is no way that you can learn how to modify your behaviour by reading it in books. The only way to do it is to be in the market, get your feet dirty, experience it, and ideally experience it with someone that can guide you. So that's all that I've got to cover, and so I'll throw open to questions now. And I did get one question in advance, and I'm very happy to receive questions in advance for those of you in future weeks. So the question that I got was to do with the person received a dividend check on the 21st of March for shares that they'd sold on the 2nd of March. What the heck's going on there? Well, it's quite simple, really. The companies have basically a dividend record date, and that dividend record date looks at all the shareholders that were on the record books as owning shares on that particular date. So obviously the record date was prior to the 2nd of March. Now, depending on the company, they may pay that dividend fairly promptly after the record date, and some companies may pay that dividend significantly after the record date. So it's just as long as you're on the books at the date, then you receive the dividend. I can assure you they won't have made a mistake and sent you a dividend check that you weren't entitled to. Okay, so it's over to you for questions on pretty much anything that you really want to ask about, and I'm assuming that that you all know you've got a little control block there where you can just put questions into a little section where it says type message here. So hopefully you all know how to do that. Just while I'm waiting for any questions to come through, we'll just have a look at today's market in terms of the index. So you can see the ASX 200, which is the indicator of the main part of our market, but it's really only telling us what BHP, Rio, and the banks and a couple of other large stocks are doing. So it doesn't really help us that much. And you can see, as opposed to the S&P 500, that this has just deteriorated into a long sideways consolidation without any real action at all. Let's have a look by comparison at the Small Ordinaries Index, which you can see has been trending quite nicely since the end of December. But and I don't have an index on this, but if you could then break that Small Ordinaries Index down into energy stocks and gold stocks, you would see some incredibly strong patterns. So certainly there's not a lot happening at the main index level in our market. Okay, now I've got a question here. SAR, which is Saracen Resources, issued an HYR. I'm not sure what an HYR is. On the 29th of February. I kind of liked, but the market didn't, what to look out for in gold stock reports. I'm just wondering what an HYR is. I'm just wondering, thank you very much, Roman, silly me, half year report. I just hadn't seen it referred to in that manner before. Let's have a look at the price chart of Saracen. And look, they really have taken a real thumping. They were trading up around 96 back in December, and they got to a low of the mid-50s. Now, I remember reading their half-yearly report, and I remember thinking that it was quite reasonable and there wasn't any real nasties in there. So I'm at a loss. I really am. I must go back and look at that half-yearly report again to try and find out what the heck the market's problem is with SAR at the moment. Because I'm with you, Roman. I didn't see what was so disastrously wrong, and And if you have a look at the fundamentals around Saracen, let's just have a look at some of the fundamentals around Saracen. Now, I just use a database called Stock Doctor, which I find very, very good. The things that I look for, so you asked me a question about what do I look for in gold stock reports. Specifically with gold stocks, I'm looking for things like the amount of resource, but also I calculate what I call a mineable gold figure, which is taking basically 100% of the reserve, which is the highest category of, sorry, the word's just escaping me, of confidence, the highest confidence category. I then take a portion of the resource, which is like a lower confidence level of what's in the ground, and then an even lower percentage of the potential, which some companies declare. So I come up with what I call a mineable gold figure. I then look at what that is worth when you've subtracted the average cash costs. So I get a figure that tells me how much realistically recoverable gold after they've processed it is in the ground. I then take half of that figure just to be super conservative, and then I look at that against the market capitalisation, and that gives me a feel for whether the company is overvalued or undervalued. So that's one thing that I look at. The next thing that I look at is obviously the management team and their experience in bringing gold mines to fruition in the past. I look at things like access to infrastructure. Are they close to all the things that they need? Water, power, transportation. How much money needs to be spent on all of those things? I'll look at if they're still in the development phase, how much cash they've got in the bank. If they're an existing producer, I want to have a look at obviously how much blue sky drilling potential they've got. So they're all fundamental things that I look at. And if they are a producer, I'll then look at things, and this is what I do for all businesses, I look at return on equity. That's the key driving figure for me. If a company's got solid and consistent return on equities, then that drives shareholder value and ultimately drives the share price. So I look at return on equity, I look at earnings per share growth over a period of time, preferably averaged over 3 years, and I look at price earnings multiple. Now you can see here we did have a bit of a reduction in the last annual earnings per share was showing 8 cents a share. The forecast in June this year is for a reduction, and I just can't remember why there's a reduction. That's what I need to go and look at. But the forecast, and these are our forecasts, so you've got to take them with a grain of salt. But the forecasts are for substantial rise into 2013, which, if that played out, would represent a price earnings multiple of less than 4, which is crazy for a company of this quality. So the long answer to your question, Roman, is I really don't know. I should go back and restudy that half-yearly report again, but the market is pretty unforgiving at the moment for gold stocks because the sentiment is poor towards them. If we look at the key gold mining indexes in the States, this is the GDX, which is an ETF covering the 16 largest gold miners in the world, and you can see it's been lagging the price of gold to an extraordinary degree for a long period of time. This goes back to November of 2010. Gold's gone up a lot in that time, and this is the junior GDXJ. So sentiment towards gold stocks globally is very, very poor, and I do not have an explanation for that. And so any disappointment here in the local gold stocks is going to get hammered pretty hard, and that's just the reality. But we will see that turn around. Okay, now I've got some more questions here regarding, could I explain CHESS, HIN numbers, SRN, sponsoring brokers, etc. What are they and what information do I need to record when I trade if it's with the same broker. Okay, all right, well, CHESS is basically the system under which all share transactions and share ownerships are covered. If you, probably the simplest way, if you just Google the word CHESS, there, Douglas, you'll find a more exact explanation. But it's basically it's the share management system, if you like, for Australia, and I think it's called. I'm not even going to try and remember what it's called. Now, HIN numbers and SRN numbers. A HIN number is the holder identification number, and when you buy a share through a broker, you are given a HIN number, which is your number with that broker. The SRN number is basically an issuer-sponsored number. If you're buying, and I think I've got this right, if you're buying shares directly from a company, as in let's say a float, then there's an SRN number rather than a HIN number assigned to it. So when you wanted to sell a share that's covered under an SRN, you need to provide that SRN number to the broker who's going to sell it to you. Whereas if you've got a HIN number with that broker, you don't have to do that. Now, if you wish to change your shareholding from a particular broker to another broker, then you can do that. You can apply to that. There's a form to fill out that you give to your existing broker, and he will transfer those shares over, and you'll then be issued with a new HIN number on the new broker. What information do you need to record? This is what I do, and I can't put my hand on my heart and say that this is complete and this is what you should do, but this is what my accountant is happy with. I basically keep very little. I run all my trading on a spreadsheet, just a simple Excel spreadsheet, and I print out statements quarterly from the trading platforms that I use, and I give them to my bookkeeper. And that's pretty much all I do, and I don't really keep anything else, other than obviously dividend checks and that sort of thing. And the only other paperwork that I do is I fill out, if the company requests my tax file number information for dividend purposes, then I'll supply that, because you obviously don't want to be paying the higher withholding tax rate. But look, I do very, very little in that regard, so shouldn't burn up a lot of time at all. Now, can I comment on NCM? That's kind of drawing me into an area that I can't really go in this forum, other than to pass some very general observations. You can see the share price has really it's really been in decline since around November 2010. Now, again, I think there's a couple of reasons for this, going very much against the trend in gold. And you've got to remember that Newcrest is also a reasonably significant copper producer as well, but copper's also been reasonably strong during that period. The things that I think are impacting on Newcrest in terms of a fairly weak share price, obviously the global situation with respect to gold sentiment to gold stocks is not good, so it's getting affected like every other gold stock is. They do have exposure to Indonesia, so these changes to the Indonesian mining laws are not at all helpful, and there's a bit of a debate at the moment as to which projects, if not all, are caught up in these new mining laws. They have had some issues with their operation in New Guinea, from memory, a little while back. So there's some of the things that are weighing on the share price. And I think the other thing compared to 2010 is that there's always been a very big takeover expectation built into the Newcrest share price. So I think back here in 2010, when the price was up above $40, it was probably just a bit expensive. And if we look at the price earnings multiple now on Newcrest, we'll find that it's it's still nearly 17 times earnings now. That comes back a bit going into next year, which is what the market really should be starting to price in. But this share has never been cheap. It's never been a cheap stock. So I'm looking for opportunities to trade this stock, but merely using the concept that I use, that I think is extremely valuable, and that's the concept of reversion to the mean. So I'm looking for a short-term trading opportunity, and I guess there'll be a time when sentiment to gold stocks turns, and we'll see probably some substantial upside in Newcrest, but I wouldn't hazard a guess at the moment as to where that might be, and at the moment, the share price is in decline, so you need to bear that very clearly in mind. Okay, well that appears to be all the questions for now. So, oh no, I've got another one here. Why have gold stocks not doing the same as gold? Sorry, why have gold stocks not done the same as gold? They are the ones that find it. I don't get it. Yeah, well, neither do I, Peter. I don't get it either. I guess that's one of the things that makes trading in the market a really interesting exercise, and it's one of the reasons that I don't rely completely on fundamentals. In fact, I look at fundamentals a lot, certainly when I'm analysing businesses, but I would never, ever, ever buy a share without having a share price chart to look at, because the price charts tell me about crowd behaviour, and it's a skill that I've developed over many years of reading crowd behaviour, and once you've developed that skill, it gives you one heck of an edge in the market. So sometimes the fundamentals just do not make sense, I'm afraid, and that's why charting is so important. Okay, well that appears to be all the questions. I hope that's been a valuable session for everybody, and I look forward to seeing you back again next week. Cheers.